In this chapter, we are going to learn about depreciation. In simple terms, depreciation can be defined as the amount by which an asset loses its value over a period of time. It is actually a process of allocation and not of valuation. It allocates the cost of asset to the periods that benefit from the service rendered by that asset. The amount of depreciation that is accumulated over time is known as accumulated depreciation. There are four factors to be considered in depreciation: cost, the net cost of the asset; residual value, it is the scrap value of the asset after the end of its usage period; depreciation cost, the cost minus residual value; and estimated useful life of the asset. There are mainly four methods to calculate depreciation: straight line depreciation, declining balance method, double declining balance method, and sum of the years digits method. Straight line depreciation. This method assumes that the asset loses an equal amount of value each year. It is computed as cost minus residual value divided by estimated useful life. In this method, the total depreciation value is spread evenly over the asset's useful life. Now, let's calculate the depreciation for an asset worth Rs 20,000 with scrap value of Rs 5,000 after a life of 5 years. So, as per the formula, we get 20,000 minus 5,000 divided by 5, which results in Rs 3,000 as depreciation per year. Hence, for 5 years, the total depreciation is Rs 15,000. That is, as mentioned earlier, this Rs 15,000 is distributed equally over the period of 5 years as Rs 3,000 per year. Declining balance method. This method assumes that the asset loses an equal percentage of value every year, that is, a constant depreciation rate. Here, the depreciation is computed by multiplying the depreciation rate with book value. Usually, the depreciation rate will be given in problems. If not, it is determined by multiplying accelerator with straight line rate, where accelerator is a multiplication factor that accelerates depreciation, such as 150%, 200%, etc. And straight line rate is the depreciation rate determined with the help of straight line depreciation method. During the first accounting period, the accumulated depreciation is 0. So, book value is equal to its cost. Since book value decreases after each depreciation charge, the depreciation expense declines in successive charges. That is, a higher depreciation in the earlier years than in the later. Here, such calculation stops when the book value falls below the estimated scrap value. In other words, the depreciation is allowed up to the point where book value equals the scrap value. If the value of accelerator is 200%, then it usually becomes the double declining method. Double declining balance method. This is a type of declining balance method in which depreciation rate is double the straight line depreciation rate, that is 200%. Therefore, to compute depreciation, the depreciation value using straight line method is calculated and thereby the depreciation rate. This rate is then doubled. As is indicated in the previous method, this depreciation rate is multiplied with the book value to get the depreciation per year. When the book value equals scrap value, since no more depreciation is possible, it will be taken as 0 for the remaining period. It will be more clear when we look at an example. Now, let's take the same case of an asset worth Rs 20,000 having a scrap value of Rs 5,000 after its life of 5 years. So, as per straight line method, depreciation value is 3000 per year and depreciation rate equals depreciation per year divided by the total depreciation, which gives 20%. Therefore, in double declining method, this rate gets doubled and the depreciation rate will be 40%. So, depreciation in first year will be 20,000 into 40%, which is 8,000. And depreciation in second year will be remaining book value into 40%, that is 20,000 minus 8,000, that is 12,000 into 40%, which will be 4,800. Then depreciation in the third year will be 12,000 minus 4,800 into 40%, which gives 2,880, which will not be acceptable. It is because when we calculate the book value for next year, it will give 7,200 minus 2,880, that is 4,320, which is less than the salvage value of Rs 5,000. Since book value cannot be taken less than the salvage value, we calculate the depreciation for third year as 7,200 minus 5,000, that is 2,200. When we sum up the depreciation in these years, it will give 8,000 plus 4,800 plus 2,200, which will be 15,000. This is the total depreciation allowed in this case. In other words, no more depreciation value can be shown. So, in the remaining 2 years, the depreciation value will be taken as 0. Sum of the years digits method. This is another method of calculating depreciation which assumes higher depreciation charge and thus greater tax benefit in the early years of an asset's life. In order to calculate, at first the estimated life of asset is taken. Then count back from the last to first and sum up the years digits. So, if we take n number of years, it will be like n plus n minus 1 plus n minus 2 up to 1, that is sigma n. Hence, the depreciation in first year will become depreciable base into n divided by sigma n. Here, depreciable base is the total depreciation, that is book value minus scrap value. The depreciation in second year becomes depreciable base into n minus 1 divided by sigma n, since n minus 1 is the second last year. This pattern continues till the year's digits becomes 1. In order to understand well, we'll take the same previous example. Here, the depreciable base equals 20,000 minus 5,000, which is equal to 15,000. Since the expected life is 5 years, the sum of years digits is 5 plus 4 plus 3 plus 2 plus 1, that is 15. This is sigma n. Therefore, depreciation in first year equals 15,000 into 5 by 15, which is equal to 5,000. The depreciation in second year equals 15,000 into 4 by 15, which is equal to 4,000. As such, the depreciation is calculated up to the 5th year. Now, let's compare these methods. Here, we have taken the same example and the computed depreciation value under each method. While the straight line method provides equal depreciation every year, the other two methods have a higher depreciation in the beginning and lower in the end. So, the firms that require higher tax benefits will make use of these two methods. Even the sum of years digits method assumes a gradual decrease each year. The double depreciation assumes a sudden dip in the depreciation values. Hence, the management of firms has to carefully choose which depreciation method is to be used.